Robert, I know you've been watching some of the risk factors coming from Washington for the markets, the debt ceiling, potential higher tax legislation. You think that's having an impact here or will do so in the coming weeks and months?
Thank you, Sarah, for having me on. I would say right now the market is not explicitly focused on those items. They are aware of the debt ceiling battle that's going to be ahead. They're aware of any potential tax legislation, but it's too early to know exactly what the details are going to be. We foresee a lot of horse trading to occur on both sides of the aisle before any legislation is passed. We do think the market is aware of it, and but from our focus and what we've seen is that the market is likely to have higher earnings from corporations next year, in spite of all the tax increases that may be bandied about, which would lead to a higher market in 2022.
Charlie, when you have these down days, does it make you think that the cyclicals are due to bounce more, or those big tech names that have kind of let us low? Do you stay very firmly focused on the names you already have in your portfolio?
Yeah, we've even got a wider gap between value stocks and growth than we've had before because, as I've mentioned, the last 5 months, growth has outperformed value. So, we've got names like Goldman Sachs trading at 10 times earnings, and we've got Borg Warner, we talked about before, trading at 9 times earnings. So we still think they've got support through their earnings that the large cap tech names don't have. There's nothing to prevent a stock trading at 35 times earnings to go to 30. It's hard a stock trading at 8 times earnings to go to 6.
What about you, Robert? Where are you looking right now? It says you like secular growers. Does that mean technology?
Yes, it does. We like companies really that are secular growers, companies that have a pricing advantage against its competition, companies that can raise prices, and companies that are in growing markets. And so, in a diversified portfolio, we would be leading with technology, healthcare, and consumer discretion. As people go back to work, they're going to spend more money. And so that's a reason for consumer discretion. Technology has become the bedrock of portfolios. Companies have found that technology is essential for business formation, for productivity, and for actually the survival of their own business. And so we would continue to believe the large cap tech is the right place to be. And we're in the middle of a digital revolution here, productivity revolution, that everybody has to know and everybody has realized I have to have technology to offset higher input costs and higher wages.
Charlie, how are you feeling about your financials, which I believe is Lazard and Goldman Sachs? And I know you always think that M&A is going to continue, but do you ever worry that we're actually peaking out on things like that?
Yeah, we obviously worry about it, but everything we're hearing from Ken Jacobson and the things that David Solomon have said about M&A is that the backlog is in excellent shape. Low interest rates, ample financing, optimism about the economy, and frankly, the need to make strategic moves is producing a big backlog. We think we're going to have a record year in M&A. That's going to be very good for Goldman and Lazard. And then higher interest rates are going to be good for names like Northern Trust. So we are very bullish on these names.